Yes, good morning, everybody.
Good morning, ma'am.
Good morning, ma'am.
So, in our yesterday's class, we have discussed about the basic rules, that is, the principles and conventions on which accounting is done all over the world. So, today we'll briefly know about what are accounting standards that have been adopted worldwide by companies so that there is an uniformity in the way accounting is done and you can compare between industries. Okay, so we have a list of say around 30 plus accounting standards based on which institutions, organizations all around the world maintain their accounts. Okay, so accounting standards means the basic format on which accounts should be maintained by companies before they are disclosing it. Okay, so the first one is disclosure accounting standard 1, that is these are given by international accounting standards. Even your ICAI, that is Chartered Accounting for Institution of say of India, has given these standards. So on that basis, the first one, the disclosure of accounting policy. So every company has to disclose about which policies it is adopting. Okay, so what policies means, how accounts have been maintained, which concept they are using, whether they are doing it on cash basis or they are doing it on credit basis, what system of accounts is maintained, it is a statement form or a T form. So all those things about how they do, which policy is used, whether it is historical cost or what cost, every detail about the principles on how accounting is done in that company should be disclosed as per accounting standard 1. Then the second one is about valuation and presentation of inventories. Now, what do you mean by inventories? Inventory is nothing but the stock of raw material or finished product or semi-finished products in the godown. Now, whenever you are doing a business, say for example, if you talk to hospitality industry, we will take an example of an hotel. So when a hotel you are running, what are the items needed? You need groceries, you need fruits, you need vegetables, flour, and so on. Okay, so that those are the basic raw materials which you need to make a product. Okay, when you talk about say any for food or catering unit, so they need raw materials which they will then convert it into the finished product. Say they make bread or sweets or pizzas or whatever it is. So every time there is some amount of finished product always ready. If you talk about any other industry, if you take say for example garments, okay, so there is a raw material, there is a finished clothing which is always there in the inventory. So when you're evaluating the inventory, what are the rules you are maintaining? So when when you're evaluating what you call as raw materials, we have different methods. One is called as a LIFO, LIFO. One is the FIFO. These are the abbreviations, or weighted average. Okay, so LIFO means last in first out, means that material which you have bought last will be used first, and this is done when the raw material cost is frequently changing and it is increasing every day. So the costliest thing which you have bought, you want to sell it first so that you get back your investment made. Okay, so last in first out means the recent bought raw material is used first for production. So that is last in first out. Similarly, we have one more method, that is FIFO, what is first in first out. here we are going to use those raw materials which have been purchased first. Okay, so this type of a system is done when there are stable prices or when the shelf life of that raw material is very less. Now, what do you mean by shelf life? Yes, anybody? What do you mean by shelf life? Whoever knows the answer, unmute and answer.
Durability of that material or any product.
Durability of a material, for example.
Hello.
Yeah, for example.
Like for dairy products, it will be only for 1 day.
Okay.
If kept in room temperature, and if kept in the refrigerator of something, it may
Huh.
increase.
Okay.
The width of the shelf life may increase. So
Okay.
this is the shelf life.
Yes. So shelf life means the time it can be stored, the amount of time it can be used. So if the shelf life is less, we are going to use it beforehand. So that is FIFO method of doing valuation. Means whichever product or raw material you have purchased first, you are going to use it beforehand. Okay, so which type of a method? Then one more method I told you, weighted average. So a weighted average means you are taking an average of the raw materials which are there in the go down, means first and last. Both price average ಮಾಡಿ ಅದನ್ನ ನಾವು ತೋರಿಸ್ತೀವಿ. So that is weighted average. So the accounting standard 2 tells us that you have to tell how you have evaluated your inventory, whether it is FIFO method or LIFO method, or on what basis are you, when you're talking about finished product, whether you are assigning all the cost involved. We have different types of cost, that is direct and indirect. Direct cost means the amount of labor, raw materials and other overheads needed, then plus, so this is direct overhead. So if you add to this your office expenses, your promotion expenses, your distribution expenses, then you will get the total cost of the product. So how are you going to price the product? How are you going to evaluate your inventory of stock? All those details should be given in this accounting standard 2. Then the accounting standard 3 is a format where you are having a consolidated financial statement. Now, what do you mean by consolidated? Consolidated means when say you are having more than 1 units. Okay, so you are producing more than one product, and so you have different subsidiaries or branches. So you club up all the assets of all the departments, all the subsidiaries, and put it in one single statement. So that is called as a consolidated balance sheet, financial statement, where in one statement you are telling the details of every business what you have. Next, accounting standard 4. It is about depreciation accounting. So depreciation means the reduction in the value of an asset because of its use, because of its wear and tear. Okay, say for example, say a machine is bought and you are using it every year. Over the period, its capacity, its efficiency is going to deteriorate because you have used it. That's the reason why every year we show depreciation as an expense. Okay, a percentage of the cost of the asset is shown as an expense because maybe after the end of the lifetime of that asset, we need to purchase a new asset or replace that existing asset. For that, we need funds. So every year we are keeping aside some amount as depreciation because that machine is used or that equipment or that asset is used. So which type of a depreciation method you are using? We have different types of depreciation methods. It is straight line, diminishing value, and so there are n numbers, and fixed installment method and sinking fund method, so many others. So based on which type of a asset you have, what type of a industry you are going to choose a particular type of depreciation method. So sum of digits and whatnot. Say there are 10 to 15 different ways of depreciating accounts. So when you're talking about technology products are depreciated at a higher rate than normal products. Why? Because they became outdated very soon. So for example, you buy a mobile phone, say next month you go to sell it, you will get a much lesser price than what you have invested. Okay, so depreciation accounting, here we are going to give the details of the type of depreciation method you are using in your business, how much is the percentage, how it is done, for which asset, what type of a depreciation method is used. All details should be written as per this accounting standard 4, that is depreciation accounting. Next is accounting standard 5, where you are going to disclose the information about all those things which you are going to disclose in your financial statement. So I told you we follow the principle of full disclosure. So it is going to tell what all details you have given. So if say whenever there is a statement there for some particular items there is a star mark. So if there is any explanation needed for any type of say debit or credit, that detail should be given as per accounting standard 5. Then the next one is accounting standard 6, that is accounting responses to change in prices. So accounting responses to change prices means if you are changing the type of pricing system, or you are going to show any appreciation you have done in pricing the products, all those details of how you have changed, what are the additional we can say adjustment done, that all details will be given according to accounting standard 6. Then the next one is statement of change in financial position. So this is a comparative statement where you are taking 2 years financial statements. It may be a profit and loss account or balance sheet. So you are taking last year's and this year's, and you're going to show what is the position last year and how much it has increased or decreased each asset or liability wise. So if asset is increased, how much it is increased and why it is increased. It is because of purchase or because of revaluation. If there is a decrease in an asset, which type of asset is decreased in its value? Is it because of depreciation or you have sold a particular item? So you are going to tell between 2 financial years what are the changes in the assets, in the liabilities, how much was the increase in profit, how much or decrease in profit, or maybe increase in expenses or revenue. All details will be given under this accounting standard 7. So there is some printing mistake or there is a mistake in one slide. So I will take about it later. So then we'll talk about accounting standard 13. Here it is telling about the presentation of current assets and liabilities. Now, what is the meaning of current assets? Now, when you talk about assets, we have different types of assets. Those assets which we buy once in a while, say for example, land, machine, say building, or say vehicles. So all these assets are not purchased every day, means their value will not change every day. There are certain other assets which we need for our daily production, daily circulation. It may be the cash in bank, cash in hand, stock of inventory, or your debtors, advance given by customers, and so on. So these are terms. So those assets which change their form every day, which are used in operations, which are used in productions, such assets are called as current assets. Similarly, we have liabilities 2 types. So we have long-term liabilities, means those amount of investment which we are which are invested by either by the owner, or you have taken a loan, or say a finance from a finance company. So this is liability, means that amount which we are owing. So that are again bifurcated into current liabilities and long-term liabilities. So if you are taking a huge loan payable in next 20 years, that is a long-term liability. Then what is a current liability? So those things which you have to pay within 1 year. Say for example, you have to purchase raw materials from your supplier and you are going to pay them today. You buy it, you're going to pay them maybe next month or in next 45 days. Okay, or you have taken a bank overdraft. What is a bank overdraft? You can withdraw money even if the balance is zero, and this is only possible for business accounts, what you call it as current accounts. It is not possible for savings account. So if there is a bank overdraft, you are getting, or you are having a credit card, if you're talking about personal, okay, so you're going to buy it today, and you have to make the payment in next 45 days. So any payment which is delayed by 1 month or 2 months or within 1 year, so such payment which you have to do is called as current liabilities. So in this accounting standard 13, you are going to tell what are the different type of current assets, how are they presented. Whether you are talking about, you are writing cash first, means liquid asset first, or you're writing stock, then debtors. So how are they presented? That is done in this accounting standard. The next is reporting of financial information by segments. Now, in consolidated by financial statements, we are what you can say, you are taking a combination, or you can taking a total of all the assets and liabilities of the total big huge company with its subsidiaries. But here in accounting standard 14, we are reporting financial instruments by segments, means say department wise or branch wise or subsidiary wise. So you can know which branch or subsidiary is doing good, where there is loss, and as per that you can take necessary actions to improve the business. So that is about accounting standard 14, which is reporting of financial information. Then 15, accounting standard 15, here the information is reflected based on the effect of changing in prices. Means say as you are doing the business, the raw material price may change, or maybe the overheads may change. Now what are overheads? Overheads are those expenses which are needed for processing the product. It may be the current bill, the rent, the security guard, the office staff, all these things, the water, something, or say telephones. So all these, if the prices increase, that will reflect on the product. Why? Because whatever expenses have been made, it should be, can say, recovered by the sale in price. So because maybe of the price rise in the raw materials or overheads, there is change in price, or if there is a decrease in the cost, also there is decrease in price. So you have to, in this accounting standard 15, we have to give the details about why price has changed, or if it has increased, how it has increased, which are the key terms or key ingredients where price has risen. So any change, positive or negative in prices, should be given with details with the particular item, so that you can think of doing R&D and reducing the cost of the product. Because if the product cost increases too much, it will hamper the sales of the product. Okay, so this is all about accounting standard 15. Then accounting standard 16, it is accounting for property and plant. So it is a specialized, or you can say specific accounting standard, where you are taking care of only fixed assets. Which type of fixed assets are there? What are the depreciation methods used? What is the, you can say, how much was there an increase or decrease in that particular property or asset over that year? So details about each fixed assets is given in accounting standard 16. Okay, so we had missed one slide. So this is here. It is accounting standard 8. It is talking about unusual and prior period items and changes in accounting policies. Say some say items in the balance sheet or in the profit and loss are there, which rarely occur, or which are there redundant because of maybe it is not paid or received for several years. So such item details, this rare items may be at the start of the company, when you had launched the company, there are some items which are huge, say huge in amount, so they are not debited in the first year itself. Why? Because if that much of expenses is debited, it will show a huge loss, and which gives a negative impact on the owner and the people who are interested in the business. So such expenses are called as incorporation expenses. So when you are launching, there are huge expenses and there is no sales as such, so expenses are not deducted on whole all of the sudden. So over the period of couple of years, they are debited and recovered from the profit. So this is one of the unusual item. So similarly, if there is a huge advertisement expense, so there was some technical problem. So we'll resume our discussion. So I was talking about accounting standard 8. So this is all about those items which are huge in number or which occur once in a while, and the details about how they are debited or credited will be given in this accounting standard. Then the next is accounting for research and development activities. So this accounting standard gives, it is a statement where if you have a research and development department, the amount invested spent in research, how it was utilized, what is the stage of development of that particular product, okay, the pilot product on which research is done. So all details of the expenses spent or to be spent on the research and development activities will be given in detail in accounting standard 9. The next is accounting standard 10. Here contingencies and events occurring after balance sheet dates are given. See, sometimes what happens is, say for example, balance sheet is prepared at the end of a particular year. Okay, so after you prepare your balance sheet, also something is going on in the business. It's not that you can say this day I'm switching off. It's not like 9 to 5 job, right? Within 5 only you will get all the payments or receipts. You may get it at night, you may get it afterwards also. So continuous job is there. So after you have prepared a balance sheet, some amount must have dropped in. So that items are shown under this accounting standard 10. Okay, then contingencies. What are contingencies? Contingencies means anything which may occur. Say for example, a company is having a case filed against it, and if it loses that case, it might have to pay a huge penalty or a fine. Okay, so even if the chances are there you are going to win the case, but still you provide for some loss. I told you we talk about say conservatism convention, where you feel safe. For emergencies, you keep some amount. So if some amount, such an amount is kept, we are going to show it in accounting standard 10. The next is accounting standard 11, where you are going to show the details about any construction contracts. Means you are expanding your business, so you are say building one more property around. So any expenses spent, how it is spent, how much it is spent, all those details will be given by this accounting standard. Then next is accounting for taxes on income. So here you're going to give the details of if any extra income or the income, say for example, one of your property is being given rented to somebody else, and from that you're getting some income. So how much tax you're paying on that? Details of that is given in Accounting Standard 12. So there are many more such standards, but for today's session, I think this much is more than enough. So if you have any doubts, please ask.